Inflation doesn't have to hit 2% before the Bank of England reduced the rates. So our buddy, Andrew Bailey, the big boss at the Bank of England, he dropped a bit of a bombshell today. He says, we don't need to wait for inflation to chill down to 2% before we think about cutting interest rates. So why should you care? Well, interest rates are like the economy's thermostat. When it's too hot, inflation's high, they want to turn it up, raise rates to cool things down. But high rates means borrowing gets pricier. Think mortgages, loans and that sort of thing. So what are the bank looking at? Well, Bailey's gang, the Monetary Policy Committee, keeps an eye on a few things. Number one, how much stuff costs, especially services. And when we say especially services, we're talking about things like haircuts, restaurant meals and car repairs. The Bank of England watches these prices closely because they can tell us a lot about how the economy is doing. Number two, they look at wages catching up with prices. This is about whether people's paychecks are keeping pace with the cost of living. If prices go up but wages don't, people can afford less. The bank hopes to see wages rise at the same rate as prices, so everyone's purchasing power stays the same. And the other thing they look at is jobs and how easy it is to find one. They're kind of like the economy's health check. If things start to look better, they might be able to cut the rates. So why this matters to you? A tiny recession just hit us, but Bailey thinks it's going to be a short one. And if he's right, and they do cut rates, it could mean cheaper loans and mortgages, more breathing space for your budget, and hopefully a quicker bounce back for our economy. So there you have it. A bit of hope on the horizon for our pockets. Keep an eye on those interest rates. They might just get a little friendlier for us all.